try to understand what is the background of you guys. I mean, Priya has got some commerce background, so he might understand. For him, it's more of a refresh thing. But Anamika, Rajiv, and Anirudh, what are your backgrounds? I think Rajiv, you're an engineer, right?
So for me, it's like French and Italian.
Chinese. Ah, okay.
No,
And
I
for
was
you, Anamika?
responsible for P&L for the last 7, 8 years.
Oh, that's good. That's good. And Anirudh, what about you? Hmm. Hmm. Okay. 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 And hi, Puneet.
Mr. Puneet Jha.
Sir, you're on mute if you are speaking. Okay.
He might
Maybe.
he might be having office reserving his online till 10. So he might be in receiving end. Okay.
Oh, okay.
So
Okay.
let's start.
Fine.
No problem.
Let's start. So let me share my screen. So basically, what we will do today is the request was like you guys needed to understand a bit more details into what the professor was teaching us the other day in terms of the financial concepts. And as some of you might not have full grip on what is a balance sheet, what is an income statement, what is a cash flow. So I will explain these three concepts first, and then I will show you an illustration where I have created a few scenarios, business scenarios, so that you can actually understand how does these transactions actually get reflected, because that's very important. Whenever you hear a term, you need to understand: is it a balance sheet item, is it a cash flow item, or is it an income statement or a P&L item?
Yeah,
Yeah.
Vilas, uh,
Mm,
one of my little suggestion to you before starting this session, you just
mm.
say the golden rule of the commerce. Okay,
Sorry.
basically golden rule. You know, when we were into the graduation, that
Uh,
time we have read the golden rules. What comes in what comes in credit, what goes out debit. These are the golden rules, na? Because our commerce or the financials totally stands upon the golden rules. So golden rule needs to be explained first, then they would be able to understand the concept basically.
See, I thought of explaining it, but it might get too tricky for them to understand in such a short time. So that's
जरा
what.
यार, ये गोल्डन रूल वूल नहीं पता होता है। गोल्डन रूल यहाँ यहाँ हमको थोड़े बैलेंस शीट बनाना है।
नहीं नहीं ठीक है, पर जिन लोग को पता नहीं है तो उनको थोड़ा
नहीं,
बोल
मेरे को
देना
भी नहीं
अच्छा है।
पता, मेरे को भी नहीं पता। व्हाट से यू
ठीक है, मैं
विलास?
आपको बता दूं।
नहीं, मेरे को बहुत डर लगता है ये व्हाट गोज इन व्हाट कम्स
No,
आउट,
no, no,
डेबिट
no, no,
क्रेडिट
no, no,
मेरे
no.
को नहीं समझ में आता है।
See, I will keep it towards the end, okay? So
ओके,
what I will do is that let me explain these things. Let me explain this illustration. Let me start explaining the illustrations. Once you're finding, if you find it difficult for any reason, then I will start with the golden rules. Because if I start with the golden rules, it's so much of things to be taught in a session. And for the purpose of this course, I don't know whether you guys should know about accounting in details. Accounting is very, it's like a rule based thing. So as I will just give you a quick glimpse on what Prayaranjan was saying. So basically, during very old days, yeah, like before 1900s or before 1950s and all, there was something called cash basis of accounting. When you say cash basis of accounting, anything, any transaction that is being carried out by a business, they will record it in their books of account only if there is a cash in or cash out. Like for example, I sold my goods and I received cash, then I will record it. Yeah. If I don't get cash, I don't record it. because I might be selling goods on credit, but I won't record it unless and until I get the money. So this used to be the old fashioned accounting, which is called cash basis or single entry system. Now there are a lot of issues with that, because if you look at the books of account, you really don't know how much of money you need to collect from your credit customers, because in the first place you didn't even record their sales, right? Because you didn't get the money, so you didn't record the sales. So this was one of the major drawbacks in the single entry or in the cash basis of accounting. So then came in, the advancement came in to something called double entry system of bookkeeping. So double entry system of bookkeeping is where the golden rule, as mentioned by Priya, comes into picture, which is, you know, every transaction has got two aspects, one debit and one credit. Yeah, regardless of whether cash is involved or not. So nowadays, all the businesses follow accrual basis or the double entry system of book transactions, recording transactions. So whatever we are going to speak from now onwards, it belongs to the double entry system of bookkeeping. Regardless of whether you receive cash or not, I'm going to record it in my books of account. Even if I'm selling goods on credit, I'm going to record that in my books of account. Is that clear till now?
Yeah, very much.
Yes.
Guys, tell me. Feel free to ask any kind of questions so that we can. I don't intend to finish everything in this session, but so long as you guys are clear, it's very good. Yeah.
Yeah, sure.
Okay. So let's start with these three concepts. Yeah. So the first one is the balance sheet. Yeah. Now, even before you get into that, let me try to put it this way. See, whenever we are speaking about a business transaction, it means that whatever transaction that is happening within a business, like for example, for example, if Anirudh, for example, is paying some capital to the business, yeah, paying some money as capital to the business, okay, as a seed capital. See, we are not concerned about what happens in Anirudh's bank account. We are concerned about what happens in the business. That is clear. That has to be very clear. Otherwise, you will always get confused. Okay, I am contributed capital, but what will be my position in my bank account? That doesn't matter. For me, what matters is my business. So whatever transaction that is happening within the business is what I'm concerned. That should also be very clear. Whatever is happening between, for example, if Rajiv has borrowed certain money to Anirudh, which he contributed as capital to this business, so far as we are concerned, we whatever we are concerned is Anirudh has contributed capital to the company. Any dealings outside the books between Anirudh and Rajiv doesn't belong to the business. That's also clear, right?
Yeah.
Okay. So then we are talking about three concepts. First one is the balance sheet. Yeah, please. Yeah. When you say I, no, wait. When you're saying, oh, yes, exactly. That's correct, because you think about from the business perspective. It's under liability, but under equity, because you are the contributor. It's not an extra, because if you are again, it depends if Anirudh is a promoter or a shareholder or not. If Anirudh is a money lender where I can borrow money from for my business needs, then it's not a capital or equity. It becomes just a short term or a long term liability depending upon the commercial arrangement. Do you
What
have
the
any
bank said
right?
we have.
Yeah, do
Yeah.
you have any rights with the business in the say of the business? Maybe you will have Anirudh would have given loan to the business with a collateral security. That doesn't matter. So long as Anirudh doesn't have any say on the voting or the running of the business, it's not equity, it's just another liability. That's all.
Got it. Clear.
Yeah. Okay. Yeah. So everything what's happening within the business.
One,
Yeah.
one question, like say for an example, you are saying definitely it's not having equity kind of thing, but uh, mm, considering the situation of a bank, okay, so if I'm borrowing from bank, definitely I would have to pay a certain amount of interest as well, right?
Yes.
So directly or indirectly, it is impacting the benefit of the bank, sorry, the my organization as well.
Yes. Yes.
In that situation, what we should consider,
Liability,
liability
liability.
only, right?
Liability. Liability. Bank loan is always a liability because bank is not a shareholder. Bank
Got it.
is
Irrespective of short or the long term loan, it will always come under liability portion.
a liability. I will
Got it.
see, Rajiv. I will explain. I will give you a lot of examples once we explain these concepts before we move into the
Sure,
illustration.
sure,
Yeah.
sure, sure.
So
Thanks.
first one is balance sheet. Yeah, the most important thing is the balance. One, the first most important one is the balance sheet. Balance sheet, as Professor was mentioning, gives you a snapshot of the business position as on a particular date. Now, the most common one is annual balance sheet. Balance sheet as at 31st December 2023, balance sheet as at 31st December 2022, like that. But some companies, especially the listed companies and all, they might be filing returns on a quarterly basis. In that case, the balance sheet position would be as on that particular quarter. Maybe some businesses, maybe for the management accounting purposes, some business might be reporting the balance sheet position even on a monthly basis. But again, that's a snapshot at the end of a particular reporting period. You cannot have a balance sheet on a daily basis. Yeah. And this balance sheet will give you a picture of how much money or how much do I have on one side, and on the other side, how much do I owe. These two, the totals of these two will always be equal. As I mentioned, this is the basis of the double entry system. Debit should equal
Balance
to
sheet has to be tallied. Balance sheet has to be tallied always. If there is no tally between in balance sheet, then there might be something wrong, and either it will come under surplus or negative. Okay.
true. And again, as the golden rule says, for every transaction there is a debit and a credit, right? Debit and credit will be the total of those debits and total of those credits will be same amount. So that's why everything will go into the balance sheet and everything the left side and the right side has to exactly match at an aggregate level.
And
So that is
Vilas, I think balance sheet to a certain extent is related to the trial balance, right?
yeah.
Because
See,
yeah,
yeah. So if you want to talk about trial balance, I didn't want to confuse them with a lot of concepts. So if you need to know about trial balance, see, when individual transactions are getting recorded in the books of account, it hits something called ledger. Yeah, you would know the old registers. Remember, the in the old days there used to be long folios of registers, right?
in
Have you
banks,
not just in banks, any businesses you take, even in
any
any
businesses,
Marwadi business, also you take, they will be
right?
maintaining a lot of ledgers, right? The hard copy books. You can
Mhm.
that you can relate it as something like a ledger because that is where they will be recording the individual transactions. What
Mhm.
happens after that in recording of those individual transactions? You sum it up in something called a control account, which is nothing but the trial balance. So trial balance gives you a summary of each account at an aggregate level, and from the trial balance you take it either to the income statement or to the balance sheet. But this is just for a conceptual understanding. You don't have to get worried about this. Let's come back to the topic. So we first discussed about balance sheet. Now the next one is the income statement. So income statement gives you for the throughout the particular month or throughout the particular quarter or throughout the year, how much revenues I made as a business and how much was spent in selling or making those revenues in terms of my expenditure. So the difference between revenue and expenditure is something called profit. And this will give you how much profitable was my business or my business segment or my P&L during that particular period. Clear?
Sure, sure, sure.
Clear.
Yeah.
It's simple
Third one,
formula for profit and loss that we used to learn. Yeah.
yes, exactly. And guys, again, don't get too much bothered about so many terms, jargons, terminologies that we are hearing. You would definitely know some basics. Yeah, I'm just adding to that to just to bring that clarity. That's all. Yeah. So the third one is cash flow. Yeah, cash flow is one of the most important concepts in financial statement analysis. You will find a lot of things related to cash flow. Yeah, so we will explain that in later. But in summary, it explains how much cash came in and how much cash went out and what is my balance cash position. Yeah, when I say cash position, it's not just the physical cash in hand. It also includes how much money do I have in my bank account also. That together is called cash. It's cash and bank also. Okay, but we call it as cash flow. Okay.
Cash in
Clear?
hand and cash at bank both will come under asset side of the balance.
Exactly. Now let me tell you some examples and test your knowledge. You need to tell me where does it actually belong to. Can we do that now for 5 minutes?
Sure.
Yeah. So I think Priya, let's allow these people to answer, like Rajiv, Puneet, or Anamika or Anirudh. Yeah. Let them answer
Sure.
whether it belongs to balance sheet, income statement, or cash flow. Now let's talk about plant and
Who can
machinery.
Vilas?
So what I'm saying is that I'm going to mention certain items.
Huh?
You need to tell me where do they go and sit. Is it going to sit in income statement? Is it going to sit in balance sheet? Yeah.
Hmm.
And is there a cash flow element? Yeah.
Okay.
Because regardless of whether it's going to sit in the bank, in the balance sheet or in the income statement, sometimes there might be a cash flow element. Sometimes there will not be any cash flow element.
Hmm.
First, you tell me. I'm going to mention certain items. You need to tell me where is it going to go and sit. First, you tell me plant and machinery. Where is it going to go? Where is it going to sit?
Assets.
Assets in balance
Yeah.
sheet.
Yeah.
Yeah.
First one.
Next one, land and buildings.
Same. Balance sheet.
Assets, right?
Assets.
Assets.
Yeah.
You need to mention asset sheet. Yeah.
Oh,
Now, next one is share capital.
Liability. Liability.
cash flow.
I will come to the cash flow element later, but Anirudh mentioned income statement, and who mentioned liability?
I mentioned.
Yeah. So, Amika, you are right. Anirudh, share capital is a long-term money for the business, right? So it won't sit in the income statement. Income statement is think something like this. I mean, I'm just giving you some example. Imagine that you're buying a car. Okay. Always think about this example. Imagine that you have a car. Okay. You're buying a car. That car is your asset. That car is your business. That car is going to be your asset. Whatever petrol you're filling, petrol or diesel or whatever, electric car or electricity that you're charging, okay, that becomes your running of the business. What is needed to run the business. These kind of things will sit in your P&L, the petrol, diesel, and all. Whereas the car is going to sit in your balance sheet. Because why? Because you will be using the car not just for one particular period, right? You can use the car for n number of years, right? Maybe 4 years, 5 years, like that. Whereas the 1 liter of petrol that you're filling, you will use it during that week or day, correct? That is why share capital is kind of a seed for the business to be set up. So it has to go to the liability side under equity. Okay. Now you tell me about a long-term bank loan.
Long term.
Bank loan.
Liabilities only, right?
Liability. Loan is
Yeah.
on.
Liabilities under long-term liability.
Yeah.
Now you tell me fixed deposit.
Fixed
Cash
deposit.
cash came
Asset.
in, right?
Huh?
Fixed deposit is asset.
Yes. Under
Asset.
which? Under which one? Balance sheet. Balance sheet and asset. Yeah. And if the fixed deposit is for a period more than 12 months, where the maturity is more than 12 months, you classify it under long-term assets or investments. If it is less than 1 year, current asset. It becomes current asset. Yeah. Now you tell me salary. Where will it go and sit?
Assets and liabilities only, I think. No, how much?
Salary paid to your staff.
It's an expense.
Exactly. Because think about the petrol example.
Expenditure.
Expenditure. Because you need what do you need the salary for? You need salary for running the business. Correct? Anything
Yeah.
to do with running the business, not to set up or expand the business. Anything to do with that, running the business goes and sits in the income statement.
It will
But
come
tell me
under P&L, na?
But
Huh?
tell me something. Will all
Yeah.
salaries be
It will
considered as
come under P&L.
No. I lost it. I mean, Priya, what were you saying?
I'm saying that this salary or whatever you are saying, that will come under P&L, I think.
Exactly, income statement. Yeah, I just used the word income statement. That's a P&L income statement, whatever you can, profit and loss, you can say. We'll call it by whatever name. Now, going back to Anamika's question, whether all salaries will come and sit in the income statement, there is a slight catch there. Okay, assume that you're building an asset, like for example, you're building a factory and you're paying salary to the construction supervisor. That salary will not come into your income statement. That salary will be capitalized and reported in the balance sheet as part of the building of that asset. Because that salary, why are you paying that salary? You are paying that salary to set up an asset, right? Same thing, same example, Anamika. You are buying a car. You are paying road taxes upfront, right? Everything upfront, registration fee. This will never be reported in your income statement. You add this to the cost of the asset, right? Similarly, if you're building an asset, if you're any expenditure incurred in bringing that asset to the condition of use for business, that will have to be a balance sheet item. But
So this will come under capital expenditure, right?
Capital expenditure. So what will happen is that everything will be booked under capital expenditure. Once the construction of that asset is complete, everything will be booked under the plant and machinery or whatever factory, whatever that you're building. Till then, it will be known as capital work in progress. Is it confusing to you, Anirudh, and the rest?
One more question. Salary to the owners or board of directors?
Salary to the owners or the board of directors is an income statement item. It's management remuneration. It's a management remuneration because you are paying those salary for running the business. It's not for setting up the business, right? It's for running the business. So you will consider it under income statement.
Okay.
It's the
So
same
owner
thing.
will
And
come under income statement only. Okay.
Income statement. Okay, another example. Let's take another example. Inventory or stock. Where will it sit?
Asset.
assets.
P&L.
Correct. Assets. Because your inventory is your asset. Yeah. Treatment of inventory is slightly different. I will tell you now. What happens is that you buy some stock for trading. Like for example, Anamika, you are into this Coke thing, right? So you are assume that you are buying like one tons of crates of Coke. You will not book it under balance sheet. You will initially consider it as sorry. You will book it under balance sheet initially because it's sitting in your warehouse. When you are actually selling it, then you take the invoice value, which is how much. Like for example, you procured it at the cost of say 1,000 rupees, and you're selling it at the markup of 1,200. So 1,200 will go and sit in your income statement as revenue. And at that time, when you have actually sold it, you will create something called expenses, paid the cost of inventory that was lying in the balance sheet. So then the balance sheet inventory will come down. Clear?
Yep.
Yeah. Rajiv, Anirudh, any questions?
When you explain, it looks like everything is clear, but suddenly when I keep hearing those jargons in the meetings, I forget.
Let's try. Let's see. Let's see. I mean, uh, but going to enrich your understanding. That's all. That's all the objective. Yeah.
Yeah,
The course and all. You get see. The most important thing is you need to understand these concepts, issues, and all better. That's all. I don't think nobody is going to challenge you in terms of any accounting or anything. Yeah. So now, going back to these examples, the last one I wanted to tackle was if you take a transaction. Now let's try to identify if there is a cash flow element or not. If, for example, if you're selling goods on credit, is there a cash flow element there?
yeah. I mean, we are going to get cash, right? If you're selling something.
You're going to get, but was there any cash at that point in time when the transaction happened?
No, I don't think so.
There is no cash flow element there. Yeah, it's a credit transaction. Similarly, Anirudh contributed capital. Is there a cash involved there?
Can you please repeat, Vilas? Anirudh?
Another example, Anirudh contributed some capital to the business to become a
No,
shareholder.
it's not a cash. No,
Why?
my,
There
that is
is a
my
cash
understanding.
involved. So far as business is concerned, they got cash, right? They got cash for setting up, right? Setting up the business or becoming a shareholder. So they got cash, right? So it's a cash flow because cash
But
was
you said,
received.
but you said capital, right? I mean,
Regardless whether it's an income statement item, capital, or an P&L item, whatever it may be, is there a cash involved or not in that transaction? Is the pertinent question. If there was cash involved, definitely it will flow through the cash flow statement. Another example, you paid salary to your staff. Is there a cash flow element there?
yeah,
Huh?
yes,
Yes, you're right. Because cash, that's cash out, right?
yeah, cash out.
Guys, is it kind of clear or is it still Chinese?
Clear for me.
Rajiv, Anirudh, Anamika,
Clear, clear.
clear? Okay. Now let's move on. I think these examples are sufficient to start with. Okay. Then let's move into this illustration basically. Okay. I just wanted to show you what will these transactions, why they are sitting in these places, and how it will be hitting default statement. Yeah. It's a combination of what we were speaking till now. So let's imagine that we are setting up a new business. Okay. So the promoter, be it Anirudh or Rajiv or Anamika or whoever it is, they contributed capital. Yeah. How they contributed was like, for example, they pumped money into the bank account. That bank account was created in the name of the company. So they pumped in rupees 1,000 into that bank account. So that's why I said share capital will become part of owner's fund, right? You can see this 1,000 blues. Yeah. That becomes 1,000. Yeah. And then same time, you got money into the bank account, right? So your bank account increased, right? So your current assets will become 1,000. Debit, credit. This is credit, debit. But don't bother about that. It will be hitting two places. That's all you need to know. So what are the two aspects here? What are the two aspects you got here? One was capital and the other one was your money that you received, right? So far as the business is concerned. So the money that you receive will become your current asset, and the capital share that you're giving to Anirudh or the entrepreneur will become the owner's fund. Both these are balance sheet items. It will not have any income statement effect because the business was not even set up, right? So no business transactions, no revenue, no expenditure, no profit. But since, as I mentioned, there was a cash flow element, so cash flow will be impacted because of this. So that's why you see here, opening balance for the business for the cash flow was zero because there was no money, and then the entrepreneur pumped in 1,000 rupees, and then the closing cash balance was 1,000, and this cash balance was reported under current assets as cash. Is this? If you have any questions, please shoot now. You guys are still thinking, or
Yeah, Vilas, be in this sheet, please.
clear?
Owner's fund is considered as a current asset, right? Here,
No. This is liability. So
1,000.
this is liabilities. Yeah, these are liabilities. Owner's fund is a liability for the business because at any point in time when the business is being wound up, they need to repay this back this to the owner, right? So it's a liability for the business, and that's why I said segregate the entrepreneur from the business. So far as business is concerned, they have money in their bank account, that's an asset, but at the same time they have a liability to repay back to the owner, right? That is the owner's fund, that's a liability.
Okay, okay. Hmm.
Anirudh, are you clear? Anirudh, Puneet, any questions?
No, I think I'm good, Vilas. Thank you. Able to understand it a bit. Am I audible, Vilas?
You are, I can hear you, Puneet, but I can't hear Anirudh.
Oh, okay, okay.
Anirudh, you are not audible if you're speaking. Yeah.
I think he is audible, but I mean not his system we can hear, but I think he's not in front of his system.
Okay. So till he comes back, probably I don't know. I mean, let's continue, okay, and then see. Next scenario is you have now, see. But again, the thing is that I just showed it for the purpose of illustration. Balance sheet will be prepared only at the end of the reporting period, not on a daily basis, okay. Whereas same with the income statement and revenue. Everything will be generated at the end of the period. But for our understanding, I'm just recording it on the previous place. Okay. Okay. Now let's get into the second scenario. So this purchase, so business actually purchased inventory, retail items for trading. I think there is some background noise. Probably let me see if I can mute. Yeah. I don't know. Anirudh, are you there? Okay, so so the second scenario is you have the business has actually purchased some inventory of some retail items for trading. Okay, they are not into manufacturing yet, so they just started with trading. Yeah. So what have they purchased here? Inventory, right? So when they purchase inventory, what will happen? Where will it, as we discussed before, stock will go and sit in balance sheet, right? Correct?
Yes.
Yes, yeah.
Yes.
Just disregard this income statement for the time being, but let's look at the cash flow item. The other side was cash, right? So what happened was with their opening balance of cash was 1,000, and then they had to pay this to the supplier to get this item, right? So the cash outflow is 1,000. So what happened was cash became zero because they had to pay this in full. So this 1,000 of cash became zero, but at the same time, stock increased to 1,000. So it's just a reallocation. Does this make sense?
Yeah.
Are you able to visualize, Anamika? Let me delete it. Anamika?
Yes. Yes.
Yeah.
Yes. Yes.
Third one is whatever item that you have purchased.
Vilas, you have the
Yeah.
control, right? Put Anirudh on mute.
How do I do that? I'm just sharing my screen. Uh, there used to be something called mute all participants. I can't see that because this is not an enterprise version.
Yeah, even
Maybe
I'm not
I
able
can.
to.
Here you
I,
can mute.
okay.
Yeah.
Excuse me.
Super.
Okay. Okay. So the third scenario is now you had set up the business, you got money from the owner, you had this in bank account. With that money, you purchased some asset inventory for trading. Third thing that you did that you sold that inventory at a margin of 20%. So what
Yeah.
happened? Here you made the business. Here you made some business operations, right? Operations actually, yeah. So that's why this 1,000 margin of 20 means margin will always be on cost. So how much was the cost? 1,000. So when you say margin of 20%, it is 1,200. So the revenue will be one side is the revenue, which is 1,200. Okay, and
Yes.
then what will happen is sorry, there's something wrong. Okay, one second. So revenue becomes 1,200. As I mentioned to you before, once you sell it, you need to expense out your stock, right? Because this stock is no longer your stock, right? You sold it to a customer. So you need to take it off from your balance sheet, right? So how do you take it off from your balance sheet? You expense it as your cost of sales. So you have sold it for 1,200 of an item that you have brought for 1,000 so that your net profit will become 200. That net profit is going to get added to this 1,000 and this 1,000 becomes 1,200 because this profit belongs to the owner, right? Owner of the business, right? Again,
Correct.
you
That 1,000 is in liability side, but now.
no. You see this in the previous transaction when we purchase some inventory for trading, we treated it as an asset or stock in the balance sheet. This is assets. This side is all assets, okay? And this side is only liabilities. So this was your asset because this was lying in your warehouse. This is your product. You have the ownership of that. So that's you are the owner. The business is the owner of that asset. Yeah. So that's why it's at on the asset side of the balance sheet. Now what has happened in this transaction? You transferred these goods to the buyer. Somebody else brought it. It's no longer your goods, right? Because you collected money. So that's why whatever money you have collected will hit in your revenue account. Whatever was the cost of the goods or the cost of stock that was sold, You need to remove it from the balance sheet and you book it under cost of sales. And your margin is 200. What is your margin? Anyway, your margin is 20%. 20% of 1000 is right 200. Yeah. So that margin is what business has made from the transaction, right? Or the profit from the transaction. That profit belongs to the owner. That's why this 200 or net profit will go and sit in owner's fund.
Yeah, understood.
So, and then you see here stock reduced, right? Stock reduced,
Yes.
and what happened was suddenly your bank account increased. How? Because in the last transaction, when you purchased your stock, when cash balance was 0, but now your cash inflow was 1,200 because you sold it for 1,200. So you got cash of 1,200. So what is your closing balance of cash? 1,200. That 1,200 will come under your current assets.
Correct.
Again, you see these two tally. Clear till now?
Yes.
Puneet, clear?
Yeah, I mean, still trying to understand, but yeah, I mean,
No. Tell me where is it? Where are you getting lost? Let me try to explain. Yeah, because I don't want you to go through the sheet again and again figuring out what happened. Okay, you can tell me where did you understand the first one correctly?
yeah, the first part I understood. I think, yeah, a second
Second,
one,
yeah.
stock is 1,000 and then
What
currency.
happened in the second transaction? What happened in the second transaction? There are two aspects to any transaction. Okay, you think it like that. There are two aspects to any transaction. If you take
Okay.
the second transaction, what happened? You purchased stock, you paid money.
Yes.
So whatever you purchase the stock comes and sits in your balance sheet because
Correct.
this is stock. Whatever
Yes.
money you have paid, it neither goes to balance sheet or to the income statement, but it comes through cash flow. So you had an opening balance of 1,000 that was given by the promoter. From that you
Mm.
spent 1,000. So your closing balance is 0. So
Okay.
that's how it becomes 0. Then
Got
what
it.
happens? The third transaction is in this transaction there are two aspects. Sold inventory at a margin of 20%. What happened here? You sold your inventory is out and your money came in as sales, right? So
Yeah.
whatever money that is actually coming in goes and sits in the revenue account of 1,200 because you sold it at a margin. You sold
Yeah.
it at a margin, meaning that so you will get 1,200 as your invoice value from the customer. Now, at the same time, you need to take out the inventory from your books because that's no longer your inventory, right?
Yes.
Stock. That has been removed through income statement as your cost of sales so that you are counting only the margin as a net profit. Only your margin is your profit, right? Rest is your expenditure, right? Like same simple example. You purchase an iPhone for 10,000 rupees, not 10,000, 1 lakh rupees. Okay, you purchased an iPhone for 1 lakh rupees, yeah,
Yeah.
and then you sold it for 1,20,000. How much money by the end of the day you made?
Yeah. Net profit 20,000. Yeah.
20,000. So
Mm.
till then, it was sitting in your balance sheet as stock, but now you are removing it into P&L. But by the end of the day, how much money did you make? 20,000. That 20,000 belongs to you. That's what it says here. That
Yeah.
200 is good.
Yeah.
And here, the initial 1,000, so that 1,000 becomes 1,200.
Got it. And I mean, when we talk about taxes, right? So, I mean, as per government rules and other rules, the taxes they apply on this net profit. I mean, if they might say that, okay, whatever profit you have made, let's say 200, there will be 1% tax on that. So that you need to pay to the government. So that we need to again uh, show in income statement, right?
Wait,
I don't know.
wait. Yeah, wait. See, first of all, let me write it down. Okay, there is something called direct tax, and there is something called indirect tax. Okay,
Yes.
this is something you need to understand in the first place. What is direct tax? Is government is actually directly taxing the customer. When you say customer or the assessee, That's what we call it in income tax. Government is taxing you. In this case, you means business, right? That's an income tax. Whereas indirect tax is something like your VAT, yeah, GST, CST, yeah,
Yeah. Yeah.
customs duties. Means is an indirect tax or a pass on tax to the end customer.
Yeah.
Yeah. So
Yeah.
these things sit in balance sheet.
Yeah.
Whereas this is a charge on your P&L. But this amount you will know only at the end of a particular period.
Yeah.
After determining, so this is based on, so this one is based on, so let me carve it out. This is based on profit, whereas this is based on selling price.
Selling, yes.
Yeah. So
Yeah.
what will happen is, suppose sale of iPhone for 1 lakh rupees. Yeah. What will happen is, as a business, how much will I collect from my customer? So customer pays how much? Assuming VAT
120.
of 5%. Assuming
Yeah.
VAT of 5%. Yeah.
Hmm.
So customer pays how much?
1 lakh
1
5,000.
lakh 5,000. Yeah.
Hmm.
Business will book 1 lakh as revenue, 5,000 as VAT payable in balance sheet.
Okay.
Got it?
Hmm.
Anamika? Got it?
Yes, yes, absolutely.
Whereas, now let's come back to direct tax or income tax. What happens is, as I said, it's based on profit, right? So my business, so business profit for the period based on accumulating hundreds of transactions like this 100,000 was, say for example, 10 lakh. Yeah. And I will apply corporate income tax 35 percentage. Yeah, or 30 percentage. Let's assume 30 percentage. So this is tax to be paid to government. So this is into this will be your tax liability. This you will book it as expense in your profit and loss account. This you
Okay.
will understand, Puneet, because
Yeah.
I've explained in the below section of the document in this
Yeah.
illustration.
Yeah.
We'll come to that. Don't worry. Yeah.
Okay.
But the only portion that was missing was this GST, CST, all these indirect tax thing. Yeah.
Yeah.
So we stopped at point number 3, right? And then
Yeah.
point number 4 is another scenario. Now, in the previous transaction, we purchased the goods on cash, right? Like this 1,000 was purchased through cash, right? So that's why we saw this was a deduction in the cash flow. But now this scenario, assume that you purchase some stock on credit this time, meaning the supplier gave you a grace period of how many, some 1 month, 2 month, or whatever it may be, for you to settle the money. That's why we call it as credit transaction. Yeah. So that's why this 3,000 again I need to remove it from here. Yeah. So this 3,000 becomes your stock again, right? Because this is your product. This is your stock. Yeah. But at the same time, how did you settle? Did you settle the supplier? No. So there is no cash flow impact because there is no cash inflow, there is no cash outflow. Only thing was there is a liability that you need to pay to that particular creditor. who or supplier who gave you credit. So that you are recording it as 3,000 here. Got it?
Yes, yes.
Anamika, clear? Who else do we have on the call? Priya, anything from your side?
Yes, Satish.
So you're back. Okay. Good. That you were there and you're clear till now. Good. So now this is clear, right? Scenario 4 is clear. Now let's move into scenario 5, which is a slightly kind of a real life situation or a bit of a complicated scenario compared to the previous one. Okay. Now, how much of stock do you have in your books? From the previous scenario, how much was your stock? Tell me how much was your stock? As once we end this scenario, how much was your stock? Stock. No, stock. You purchased inventory, right? For how much? 3,000. So that stock is
3,000.
still
Correct.
3,000. Yeah. Out of the 3,000, goods worth rupees 1,000 was goods worth rupees 2,000 was sold at a margin of 25%, half of it on credit and half of it on cash. Meaning, half of the customers told me that they will pay me cash then and there. Half of my customers told me that they need 1 month to settle. Again, out of 3,000, I sold items worth 2,000 at a margin of 25%. So this becomes my total sales is 2,500 because 2,000 plus 25%. 50% of it was on cash sale and 50% was it on credit sale. Is this clear? Is this scenario clear, first of all?
Yes.
Anirudh. Puneet. Okay, since I'm not hearing anything, I'm assuming that it's clear. Okay. Then what will happen? Yeah. So what happened here was what happened? What was your total sale? You sold everything for 2,500, right? So 2,500 is your revenue, right? Including cash and credit, because cash and credit is only a differentiation that we will make in the cash flow statement. As I mentioned, the voluntary system of bookkeeping will consider revenues, whether it was cash was received or not. So your total sale will be 2,500. How much is your expenditure? Expenditure is the cost of sales, meaning the cost of goods that you have purchased for this sale, which is 2,000, right? So the margin is 500, which is your profit. That 500 will get added to this 1,200, and then the owner's fund will become 1,700. And then what happens with the stock? Let's see what happens. You had 3,000 stock. You sold 2,000 worth of stock. Now what is remaining is 1,000 stock, right? What is your receivable? Receivable meaning credit customers. You sold out of the total sales. You had 50% on credit sales and 50% on cash. So 50% of credit sales is you will receive money in the future. This is your receivable. So that receivable will be 1,250. And then let's see what is the cash position before we talk about cash. You had an opening balance cash of 1,200. You had a cash inflow of 1,250, which is the 50% of 50% of the sales you have collected cash in there, right? So that's your cash inflow. So what is the total cash balance at the end of the period? This is the closing balance. This is the closing balance that we're taking it into your balance sheet. This has to be very clear. Unless otherwise, Next scenarios will even get more complicated. Yeah. So tell me, what do you feel, Anamika? I think you are clear.
Yeah. So this is like everything that I sell is will come under
Revenue.
cash, right?
No.
A net
Everything that you sell will become your revenue.
revenue,
Out of
correct?
which, how much cash was collected will come into your cash flow.
Hmm.
Remaining will come and sit in under your receivable. Receivable meaning I need to receive it in the future. These are
Hmm.
your credit customers. That
Hmm.
portion will come under receivables. The remaining will come under cash plus the opening balance of your cash. That is the 2,450.
Hmm.
And whatever is the margin that you have made in the profit, it will get
Hmm.
added to the owner's fund.
Hmm.
And in owner's fund, again, as I mentioned, all these things will happen only at the end of the period. But just for your understanding, I'm just showing how it will get reflected. Okay.
Hmm. Hmm.
So Anirudh, Puneet, you need to tell me whether you're clear on this. Anirudh, you can type also if you just in case if your machine is not. Just got Puneet also had to drop off. So it's only Anirudh and Anamika. Anirudh, if you are also not there, let's postpone this session. Okay.
Yes, yes, yes. Because we can have this discussion.
Yeah. I think still more to go. Probably we might have to continue tomorrow. Yeah. So we reach only till 5, right? So then we have 6, which is you're making some payment to the creditor. Then they are and then they are taking a